Okay, let's answer some questions from the last market outlook. I have not seen any of these. My whole week has been taken up with this is broken, that's broken, this needs to be fixed, that needs to be repaired all week long. Okay, more about that later. Let's see. As a follow-up to my question about REIT valuation, healthcare REITs from last week, you said that as a retail investor, valuation is not a valuable tool because of a lack of information at the retail level. I didn't say so much a valuation isn't useful, but that trying to come up with a target price by a specific date and doing a cash flow forecast and forecasting revenues and all the line items and discounting them back, unless you have followed that company for a significant period of time, and unless you have access to information that can help you forecast line items by inflationary cost per the sector, unless you have some kind of healthcare experience in terms of how healthcare costs will change over time, it's going to be it'll be a useful exercise, but a rather futile exercise, because I don't know that you're going to come up with a price that would be anything more than a pretty good guess, and that would be about it, because you'll be guessing at everything. You'll be guessing at the revenue growth, you'll be guessing at the cost growth, you'll be guessing at the cost categories, you'll be guessing at the number of shares that will be issued, because REITs do have a tendency of issuing shares, not buying back shares, so you're going to have to guess at that. It's a lot of guesses. So being that you're trying to come up with a precise number in a precise period of time on a mountain of guesses, to me it seems to make a lot more sense from the retail investor perspective to say, are the conditions right for growth? And every stock usually comes down to 2 or 3 really big drivers. So it's a matter of you want to be in healthcare REITs. What are the big drivers of growth for the sector? And if those are present, then you have something. But if they're not present, then it doesn't matter. If they're present, you have something. If they're not present, you don't have something. It wouldn't matter the time you spent forecasting a mountain of guesses just to come up with what you feel is a precise number. It won't be precise. 2 questions. Can you give an example of the information I can't access at the retail level? Well, you're not going to have access to management. They're simply not going to answer your questions. An institutional analyst will have access to management through more than just the 4 conference calls each year. You're also not going to have a specific industry information, and it would take you years to develop that, and it would take you years to develop the ability to know what questions to ask. So for retail side, I don't think that there's a lot of value in it. The institutional side, that's your job. That's your job, so you got to do it. Is valuation a valuable skill for the retailer at all in any sector outside of REITs? Like I said, it's a lot of work for a very, 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 very imprecise number. It's just your best guess. And as you're forecasting, you're going to have some belief about the stock. So let's say you're going to do a cash flow forecast for Tesla and you believe in Tesla. That's going to show up in your cash flow forecast because you're going to say full self-driving, yeah, that's going to happen. Robo-taxis, yeah, by 2027 there'll be 10 million robo-taxis on the road. Never mind that Tesla won't build 10 million vehicles, but you'll forecast that kind of stuff and you'll think that it's going to actually happen. But all of that really is venture capital space. You could say that Tesla is an automaker with a bunch of venture capital investments. Robotaxi is a venture capital space. It is not proven. What has been proven has quickly been reversed. And let me tell you something. Having spent time in Costa Rica, I have a driver that drives on the roads here. I cannot see how a self-driving car can navigate this traffic with these roads. And anyone who lives in the San Jose area will know exactly what I'm talking about if you're listening. Robo-taxis on these roads, forget it. So we're talking about, a lot of different markets are offline, but you won't see that when you're forecasting because your bias will be in your numbers, right? So it is just a mountain of guesses and a mountain of biased guesses. Just think about the big drivers that need to be present for growth, and if they're there you go. Bonus question, is it possible to find alpha in supposedly efficient markets? Well, yeah, you can find alpha in efficient markets. It depends on your definition of alpha. Alpha means you have a benchmark. Otherwise, there is no alpha, right? Then everything is just a return. So alpha is your benchmark. So let's say that you have a benchmark of 1, 2, 3, 4 stocks, and they're all weighted at 25%. And it's an efficient market. But you believe that number one, let's say each of these have some kind of return, right? And then you weight them all and you come up with the return for the benchmark. You believe that number one will outperform number four, so you buy more of number one and you buy less of number four than the benchmark. These are called active weights, WA, active weights, because you're weighting your portfolio different than the benchmark. If you're right and one outperforms four, you will have a return on your portfolio that is greater than the return on the benchmark. That is alpha. But just to say, I'm going to buy 1 million shares of Tesla, it's going to go up 20%, and I beat the market. I've produced alpha. No, not really, because, that's not a good example, because the market is the S&P 500 and Tesla's in the S&P 500. You've basically just massively overweighted Tesla and massively underweighted everything else. So yeah, I'm seeing at that perspective, that would be alpha. But typically you have a benchmark, and then you will make deviations from the benchmark weights. And the difference between your portfolio and the benchmark is alpha, but only if your portfolio is reflective of the benchmark. If you have the S&P SPY as your benchmark and you're investing in penny stocks, and you produce a return that's greater than the benchmark, you can't say that you've produced alpha because you have the wrong benchmark. To say you produced alpha, you must find a benchmark of penny stocks. Did you beat the benchmark? Alpha is what you can do with active management, right? But yes, it is possible to beat your benchmark. Not very many people do it. And the more efficient the market is, the harder and harder it becomes to do. But it can be done. Would you agree that in a scenario that the Fed starts cutting rates to manage real rates, the 10-year rates wouldn't move much for the current levels? That's hard to say, because it is a matter of what causes the Fed to lower rates. If it is, the threat of deflation and wanting to keep real rates let's say at 2% as opposed to see them go to 2.5 and 3% as inflation comes down, and growth is still robust, yeah, the 10-year would probably move just a little. At that point, you'd get a significant uninversion of the curve, which means that if you are thinking about setting up a portfolio, not only would you be long duration, you would play for a curve steepener. So we have a curve that currently looks like this, and here your money market rates fairly flat. There's the 2, there's the 10, and you're thinking the Fed will lower rates. Maybe the curve will just look like this. Maybe the 10-year won't move at all. So what you would do is you'd say, well, I'm going to have duration. I'm going to have some duration in place because with rates falling, it's more than likely yields on the long end of the curve will drop as well. So I'll win there. But if you're thinking that the 10-year might stay the same while the front end of the curve drops, the bigger payoff between duration and steepener is in the curve steepener, which means you're going to be short the 2-year and long the 10-year on this one. Sorry, a curve steepener, other way around. You're long the 2-year and you're short the 10-year on this one. And you could play this with TUT. Looking back at the past year, could you discuss your top performing and most challenging trades? The most challenging trade was beta. From the end of the first quarter, somewhere, I think mid-May, I'd say, right through until July, the economic data simply wasn't changing. Earnings expectations were coming down each week, not by a lot, but they were coming down, and interest rates, from mid-May moving onwards, were still expected to increase, but the market just kept rallying, and all on AI. And having been around in 1999 for the dot-com ridiculousness, where the market would just keep going up and up and up, and you'd think, how can it possibly go any further? And it would run, it would go up another 300-400 points, and you'd think that must be it, and it would run another 300-400 points, and it kept doing that. It exhausted all the bears. It destroyed lives. If you were playing the fundamentals, it destroyed lives. Well, AI, everywhere you turn, AI. Companies were rushing to say AI as much as they possibly could on their conference call. It was everywhere. And it just had the same flavor of 1999. So I had to stop. And I stopped pretty much near the top of the rally. That's what's frustrating. It's not bad stopping in the market going on another 200-300 points. At least each day you could say, whew, thank God I stepped aside. But I pretty much stopped at the top on beta on that one, which was every day you're watching the market retreat back to 41 from 46. I think it went to 42, somewhere around 42 from 46. And you're looking at it going, you're counting up what you would have made had you not stopped. And it was just depressing. That was a frustrating trade. Top performing one, I would say selling puts on Oxy. Every time Oxy dropped under $60 and I saw it in the low 59s, 58s, 57s, I sold 55 and 57.50 puts heavily and always won. That without ever owning it, it ended up being, if you look at the top 5 performers, it's in the top 5 performers of things that I never owned. I shouldn't say of things, in the top 5 performers, and I never owned it. Just selling those puts heavily was a top performer for me. Let's see. I'm interested in hearing about your initial expectations, how they played out, and unexpected turns. I'm a fundamental person, not a behavioral person at all. So when a market turns behavioral, I'm still fundamental. And that's when it begins to punish you, especially if you're on the wrong side of the behavior. So if we look at Tesla, for example, and we look at the forecast I made for sales growth and margins, I was pretty much spot on in terms of how their margins would deteriorate over the coming years. And I did this one coming up on 2 years ago. Once we get to March, it's like 2 years ago. So almost 2 years ago I did this. I was spot on the deceleration in their growth and the contraction in their margins. And for last year, I was right on the price, but not this year, because the market, at least the market for Tesla stock, is more behavioral than it is fundamental. The valuations that I've seen, even Dr. D's, Aswath Damodaran's valuation for Tesla, uses a company cost of capital to discount cash flows from what are otherwise venture capital based projects within Tesla. And we know from corporate finance that if you have a project in a corporation that is riskier than the whole corporation, you would discount the cash flows at a project cost of capital. But I'm seeing, and it's not just one analyst, I'm seeing all analysts discounting cash flows from what would otherwise be considered moonshots, otherwise be considered venture capital space, like robo-taxis in 3 years generating $50 billion of revenue. That's a moonshot, okay? You don't discount that with a 10% or 11% weighted average cost of capital. You discount that at 50, 60%. But behaviorally, Tesla's price is responding in that sense. It's not responding fundamentally. That's sort of where I break down. So if I was a team and if I had to hire someone, I would look for someone who was really behavioral, someone who wasn't as fundamental or anchored by the fundamentals, so I could at least have their input and see how the behavioral side is thinking about things. Are you leaning more towards a recession than a soft landing? Canada, yeah. I can't see a soft landing in Canada. Now, I think it was yesterday, 2 past governors of the Bank of Canada said a soft landing is still possible, but they pretty much have to. That's sort of what they do. They're not going to criticize. No past central banker is going to criticize a current central banker. It's just not done. So I don't know that we can put too much weight on that, but I think a recession in Canada is more likely than that in the U.S. The path for a soft landing in the U.S. is narrow. The Fed would have to target a real rate and lower rates to keep the real rate, even while inflation is not at their target yet, but coming down. They would have to move earlier. And if they can do that, and if they can bring the interest rate down faster than the economy slows, you might be able to pull off a soft landing. However, they reminded us early in the process that the 70s are very much in their mind. Nobody wants to be Arthur Burns. So I think the error that they make will be in moving too late. They made an error in not moving fast enough in the beginning. At least hindsight tells us that. However, the information they had at the time, I don't know that we can fault them. The information we had at the time looked like it was supply driven, and that usually is transitory. But it was transitory for too long a period, and then it became embedded in expectations, which there is the problem. It became embedded in expectations. They may decide that even though there is sufficient evidence that inflation is coming down and the economy is cooling and unemployment is above 4%, maybe 4.2, 4.3, they might still hold off on cutting rates. That would be your hard landing right there. If they do not begin to lower rates to target a real rate as opposed to target the level of inflation, that would give them the hard landing. I'd be more apt to place weight on a soft landing if today, it is Wednesday that I'm doing this, and the Fed decision this afternoon, if in the press conference he signaled that they were going to begin considering the real rate and making sure the real rate stays where it is, then it's like, okay, well, you're going to keep your eye on the real rate. The real rate can go up as inflation goes down, and you'd have to cut rates even though you're not at your target. If you signal that, yeah, I'd probably be on board, at least 1 foot on the boat for a soft landing. Let's see. How do you think TLT, XLU, and QQQ would do in the 2 scenarios? Well, if you have a recession, TLT will go straight up because rates would be cut. I mean, if it's a hard landing, then there is no choice to cut. A soft landing means there was a choice to not cut, and the Fed chose to cut. So one of them is a choice, and the other one is you have no choice. Either way, lower rates is supportive of higher bond prices. XLU would be the same. Utilities aren't as variable. The earnings of utilities are fairly stable over the business cycle. They're just not that variable. It's because they're so bond-like in their cash flows, they will price out like bonds. The higher interest rates go, the lower the present value of those future cash flows. So XLU should do fairly well. QQQ is a wild card, right? QQQ, I think, can overcome high interest rates if the numerator is increasing. Numerator being future cash flows. If you have this idea that no, future cash flows are going to be really great, then even at higher interest rates, the price can go up because cash flows are going up faster. But QQQ responds best in 2 phases of the business cycle: early recovery and growth. QQQ loves economic growth, massively outperforms in that phase. If you don't have economic growth and you have interest rates cutting, it's questionable how the market will think about the numerator, which is the cash flows. I don't have an answer for that. It almost seems like both equities and bonds would do better in a recession rather than a soft landing. I think it sets equities up better for the next 5 or 6 years if you do have a recession. If you do have a hard landing, it sets equities up in a better position, because the thinking in the market is, okay, that's behind us. We're not going to have another one in a year. It's behind us now. Whereas if you get a soft landing, there'll always be the hesitation of, this is a long market without a true recession, not a pandemic-induced recession, but without a true recession. That doesn't feel right. There'll always be that cautiousness, right? So I think, if we're expecting punishment, let's just get the punishment out of the way so we can get on with things, so that it's not always, the threat of it's not always looming in our future. By the way, I can totally relate to waiting in the money market for January 1st so I can contribute to my TFSA and FSA. First home savings account, I think that is. When we compare the bond yields against the equity earnings yield, what is our perspective in terms of comparing apples to apples? Well, it is true. When you're looking at the yield on a bond, that is the yield you would get holding it to maturity, with small variations depending on your reinvestment of your coupon, whether you're reinvesting at higher yields or lower yields. But on the bond itself, that is the yield you would get without holding it to maturity, without anything more than just that, because maturity, you only get the face value. Now, if you have this idea that you'll sell it before maturity, you can get capital appreciation on top of that yield as interest rates come down. You can do better than the yield to maturity based on your holding period. Stocks don't have a maturity date. That's difference number one. So if you look at an earnings yield, it's like, well, yeah, but it has real potential for capital appreciation. That's just an earnings yield that I'm getting. I can get capital appreciation out of that. But you need the environment in which to get capital appreciation from. So if your investment period is a year, let's say that your holding period is 6 months or a year, there's a lot of risk in equities. Right? There is where the yield would matter more. The earnings yield would matter more. So if we're looking at the next 12 months, the earnings yield is probably more important. If you're looking at the next 10 years, then the earnings yield is meaningless. So who cares about the earnings yield? You're looking at the long-term return over full cycles or several cycles of equities versus bonds. Equities always win. But again, you're thinking about, well, what am I going to do this year? How am I going to earn this year? And if the yield, the earnings yield, is only a few basis points for equities, a few basis points above that for fixed income, you're not getting paid a lot to take on risk for the next year. But you can ignore all of that if your time frame is 10 years. So that's how you would look at that earnings yield. Please consider extending your market outlooks to podcast format. So much of what I do is visual, though, that, I've thought about it before, is how could I turn this into a podcast? And I would have to explain a lot of what I'm looking at as opposed to you being able to see it. So because a lot is visual, it's hard to get that done. The second part is, you have to ask, what's the motivation of a podcast? Why would I want a podcast? And you're suggesting, well, it reaches a wider audience. Okay, why do I want a wider audience? I don't monetize my videos. That's not really why I'm doing this. To be honest with you, there's almost no money in it. Unless you're one of the big ones that are generating millions of views, there really almost is no money in it. By the time taxes, the government takes its share for doing nothing for you, but just taking its share, it's almost not worth. And you figure out how many hours you spend doing this stuff and what you got, you're getting maybe 50 cents an hour. It's massively illegal in terms of, are you making minimum wage? No, you are not. Not even doing that, unless you're one of the big ones. Now you may counter that, well, if you do a podcast, you could become one of the big ones. I don't think so, because I'm more technical in what I'm doing. Technical meaning I'm sticking more towards a more intelligent analysis in terms of rates and things like that. I'm not hyperbolic. Market's going to crash 30% and I've got a guest on that's going to tell you where you can hide. It's silver and gold, or Tesla's going to 3,000, or Bitcoin's going to 100. I don't do stuff like that because that's just hyperbolic stuff meant to get you to click. It's really, if I do that, I'm really just speaking to people who want to hear that that's true. So people who listen to videos about Tesla going to 3,000 are people who want Tesla to go to 3,000. So they listen to that, and that's why those things get views and clicks and likes, because you're telling people what they want to hear. I don't really do that. It's not really my thing. So to say you can get a larger audience, I would never get the big audiences, because I would have to go from educating to entertaining. And only then can you get those really big audiences, which means you have to say things that intellectually are not true, but that behaviorally people want to hear. So if I wanted to be a big voice on YouTube, I would think, well, what do people want to hear? I'll tell them what they want to hear. And what's the biggest market out there? Crypto's a big market. Lots of people out there. So there are people who are not into crypto. They're not listening to this. The people who would listen to me are crypto fanatics. What do they want to know? That this stuff's going to the moon. No one's going to use fiat currencies. Governments are going to crumble around the world. They want to hear that. I'll tell them that. That's what I'll say. These governments will be out of business in 5 years. Bitcoin will be the only currency left. It's going to 100,000, then to 1 million. It'll be the only currency. I got to say shit like that. And then I'll get huge views, right? But I don't have it in me to say shit like that. So I'll never have the big audiences. I'm okay with that. XOM announced a buyback potentially worth 10% of market cap over the next 2 years. Given oil prices are relatively low again, do you think it would be a good idea to apply the put-sell strategy like GM? Not really. Not for oil companies. Oil companies behave differently. I wouldn't do an in-the-money put. I'd do an out-of-the-money put on that. So Oxy is 55, 56 bucks and under pressure because oil is selling off. When you're looking at oil companies, you have to think about it over the next 4 or 5 years. Now, the COP conference ended, and in that one, they did talk about transitioning away from fossil fuels. That wasn't going to be in there, but in the final communique, the final statement, there is words about the transition away from fossil fuels. Let's just say what everybody wants to say, and there it is. Which means CapEx in that space is going to drop. And growth in that space is going to come from consolidation. So you'll see more larger players buying smaller players and consolidating. And the smaller players will probably be more than happy to leave because the writing's on the wall. So it is now a cash flow yield thing because your CapEx is really low. So if your CapEx is really low, your free cash is very high. Your free cash flow is very high. And that will all be returned to shareholders. So you have to look at it in terms of free cash flow yield, not so much in terms of the price or some price target. So it's worth owning at a high enough free cash flow yield. When these things have free cash flow yields of 15, 16, 17%, all of that's being returned to shareholders through the dividend or buybacks. So that's your yield, the free cash flow yield, that's your yield. Well, buy. So sell puts. Not in the money puts. I would sell at the money or slightly out of the money, 40 delta or 35 delta puts on those, because if I own them, I have a lot of company cash being returned to me over the next 5, 6, 7 years, massive amounts of cash. It's going to take 20 to 30 years to move away from fossil fuel. So these companies will be cash flow generators, cash cows, for at least a decade, if not 2 decades. Why not own them? Why not own them, right? My thought was oil demand isn't going to change in the next 2 years, and price will likely stabilize in the summer with demand. But I wouldn't even look at price. When you look at Oxy, they're break-even positive, anything above mid-30s a barrel. Exxon Mobil, probably even a lower price on where their break-even is. Look at the free cash flow yield. and look at them in the sense of they're not going to do greenfield investment anymore. It's either going to be acquisitions to raise their oil reserves or brownfield development, which is less expensive to do than greenfield development. Did you close on your home in Canada yet? No, I'm probably just going to keep it for a couple of years. How does cap gains on real estate work now that you are non-resident? It is the proportion of time of which you were a non-resident. So let's say that you're a resident and you own it for 5 years. You're non-resident for 2 years and you sell it. 2/7, because you owned it for 7. 2/7 of your capital gain is taxable. Only 2/7. But in these 5 years, you bought the house for a certain price. If you've made improvements to the house at this point in time, you can say, okay, well, this is the value of the house at this point in time, based on the improvements that I made, and whatever I sell it for, that's the capital gain. 2/7 of that becomes taxable, which is not a big deal overall. It's not a big deal. I'm looking at Oxy sitting at 55.50 right now. I have 2 questions. Do you have a view on what can impact oil prices in the near term? Worried about downward price momentum. It's OPEC and OPEC Plus, and are the countries that agreed to a cut in production going to actually stick with it? The U.S. is producing, I think, more oil today than it ever has ever. Record production. So there's a lot of oil out there, which pushes the price down. As long as there are cuts, then it should support the price of oil. Now, there's 2 ways to think about this. You have a lot of consolidation that's going to happen. Are the big companies going to say, look, we're probably never going to sell all of our reserves. In time, 50 years from now, the market for oil will probably be 20% of what it is now. So should we keep the market tight for as long as we can and get the highest price, or should we just sell whatever we can? We got to sell all these reserves. Let's sell whatever we can. At some point, they're losing money on every barrel. But how they're going to manage that, I think they'll probably keep the market tight. I think the under $70 price is a big concern. So I think somewhere between 70 and 90 going forward is probably going to be the range, which is a great cash flow range, I think. I mean, under 70, why would you do it? You're trading dollars, right? It's costing you $55 to get the oil out of the ground just to sell it for $55. Why not leave it in the ground and not spend the $55 to begin with? Do you think Warren Buffett might wait for oil prices to keep going down, maybe even wait for a recession, then buy the company outright at a steep discount to today's value? He said he's not interested. He said he's not acquiring it to acquire it, or buying shares to acquire it, but you kind of got to say that. If you're him, you pretty much have to say that. I don't know how he thinks or how he looks at things, but I don't see him as a market timer in that respect. Any conviction that Ford will follow in GM's footsteps by announcing a buyback plan? Well, they cut back production on the F-150. They announced that over the past week that they're going to cut back production. If they have build-up in cash flow and they're hesitant on the EV space, then without any CapEx available or without any CapEx needs, it just makes sense to return it to shareholders. Yeah, I can see them turning their focus on their share price and doing something. I would find it hard to imagine that Ford's exec team wouldn't see the jump in GM stock price and lean towards a similar action. Yeah, there was an initial jump, but the GM's having trouble at $34 right now. So, thoughts on Apollo chief economist Torsten Slok? Recently heard him on Bloomberg. Wanted to get your opinion. Yeah, I can't recall his position off the top of my head. I am familiar with the name and his gravitas. He is well respected, but I can't bring to mind anything specific he said. But when he speaks, I do listen. I listen to a lot of voices, so it's like, what did he say last time? I don't know. I short-term memory, I forget. Can you please make a video on your outlook for 2024? Yes, I can. Can you please add to the Applied series a video on how to manage a portfolio of non-treasury bonds? Yeah, I guess I could do that. It's just they're hard to buy without a dealer. Some of these bonds are hard to buy without a dealer, which means it's going to be hard to show you on the platform unless you can actually find it and buy it and quote it. It's going to be hard without a dealer. So some things are just not really retail space. But blue chip U.S. corporates, IG corporates, yeah, you can do that. Munis, there are munis available. Yes, you can. Agency debt, yeah, it's available as well. So I could probably show something there. As a credit analyst, I'm confident that Pakistan and Brazil won't default in the next 2 years, but their sovereign 10-year yields are high. Pakistan has a strategic importance and Brazil's economic position. Okay, I know how to find their USD sovereign bonds maturing in 2 years, but then I get nervous because it's unknown territory. I'm sure that others would be in the same position. I don't know anything about any specific country. So for Pakistan and Brazil, I couldn't offer any insight into how they're doing. Either you want the bonds or you don't want the bonds. There is more risk in the US dollar bonds than in their sovereign bonds because they must come up with US dollars. And just because Pakistan is a nuclear power doesn't mean it can't default. So you are taking on that risk. But if you understand that risk and you think no, they'll be able to meet their US dollar commitments, then you're good. But beyond that, I wouldn't have an opinion on either one of those two countries. Announcement Canadian housing shortage is very insightful. My question is that what if the Conservatives come to power and dramatically reduce the quota on immigration? Even if you reduce the quota on immigration, you still have to dig yourself out of the hole you're currently in. Now, with the new student policies, the doubling of the amount of money foreign students need to show in their bank account to get a student visa. With that doubling, you're going to reduce the number of students coming into the country, which will take some pressure off of housing. And this is what you need to do at this point, is you need to massively reduce both the temporary and the permanent immigration that you have. Now, permanent immigration is very high. Temporary is extremely high as well. Those are people who come here like students or agricultural workers, seasonal workers, and then they go. They don't have permanent residency, only temporary residency. That still is a weight on housing. Well, if you massively reduce that, you start moving in the right direction. If you move that 500,000 immigration a year down to 250, something more reasonable for the size of Canada, you start moving in the right direction. But even if you cancel all of it, which is impossible to do, it's going to be very difficult to get that done. Very difficult. But even if you did, even if you cut it in half, you're still in a very deep hole of how much housing is still needed just for natural population growth. You're still in a hole. You still have to dig your way out. Will the Bank of Canada work in tandem with the Fed with respect to rate cuts? No, they won't. They each do their own thing. Despite economic indicators being worse in Canada than the U.S., no, they each do their own thing. I'm a second-year college student majoring in finance. However, I'm starting to realize that the knowledge I'm gaining from school is not as much as I thought. Yeah, careful there. There's a difference in what you learn in university and how you learn something. So be careful. It's slow. When I say it's slow, it's a lot of foundational stuff, and not a lot of practical stuff right away. It's a lot of foundational stuff. And it builds a very strong foundation that you can then build very quickly on. So I would think of, let's just draw out two graphs here, and we'll draw progress here. We'll call it practical progress. A college tends to do this. right? So that you get practical experience very quickly. Universities tend to do this, so that you get a lot of foundational knowledge, which isn't very practical, but then third year, fourth year, case study courses, it starts to come together. And once you hit the real world, since you have such a great foundation, you can really accelerate, and you end up at a plateau much higher, but you do start much slower. Good example is I'm currently learning Spanish. Now, I can learn words, and lots of words, and I can string together a sentence of just words. I don't like to learn that way. I like to break it down. We have the masculine, the feminine. We have the plural, and the singular. You have verbs which have conjugation. I want all of the rules. I want all of that foundation. Then when I get a new word, suddenly I know 15 words. Give me a verb, and I'll know 15 verbs. And I'll know it in the singular and in the plural. And I'll know it in the past and the future. So I'll know more faster later. So if I learn a lot of words without the structure, I'll hit some plateau at some point where my conversational ability will sound less than intelligent because I won't have the right structure of the language. I'm taking my time here, and it's frustrating because I'm learning sentences and things that you just don't use in normal. I am a man. You're not just going to walk around saying, I am a man, I am a man. So you got to, but it helps you learn the little words you need to make a sentence, and the right conjugations of verbs and the plural and singular, all of that stuff, so that 6 months from now, as I start adding words, I'll be like this. So I could be here in a year, or I could be here in a year. See the difference? But after 6 months, somebody who followed this process of just learning a lot of words, practical right away, would appear that it's far more successful than my strategy. But come back in a year and a half, I'll be way ahead. So careful on saying it's not as much as you thought. It seems quite small compared to what CFA Level 1 program brings. Well, the Level 1 is meant to be more encompassing of an entire undergrad in terms of the know what. Okay? This is what Level 1 is. It's a lot of know what. Level 2 is valuation level. So it becomes a little bit more practical in the sense of it's a lot of know-how, right? And then Level 3 combines the know-how with the know why and the know when. So Level 1, again, a lot of declarative knowledge. It may seem like it's more than you've learned in your first 2 years because it's focused. And it's meant to be all-encompassing of the know what's from your undergrad. Consequently, I'm considering dropping out of college. No, as I will be $40K in debt if I finish the program. Currently, I only have $10K. And I could potentially clear all 3 levels of CFA program instead. Yeah, but without the degree, it's going to be a longer road for you. The degree is a requirement for the CFA. Now, you don't necessarily need the degree if you have some life experience, but you have neither. So it's just going to shoot you in the foot. Not only that, it's not those letters that are going to make the difference. So I don't know that I would just go for those 3 letters. You really want a recognized degree and those 3 letters. And you can't think about it as $40,000 in debt. If you were building a house and you're $10,000 into the house and you say, you know what, I can't live in this house. I'm seeing that other people are living in houses they bought. I can't live in this house. Well, because it's not complete, right? I can't live in this house. I'm going to be $500,000 in debt by the time the house is built. I've only got $100,000 in it now. Should I just walk and rent an apartment? Well, that's the same thing you're asking here with your education. Your education is not an expense, it's an asset. You've made a $10,000 investment in an asset that only has value if you complete it, which means it's a $40,000 investment period, but it is an asset, an appreciating asset if you do it right. But if you go through school aiming for that solid C average or that solid B minus, you just want to get by, then it's not an asset. At that point, it's truly an expense. And if that's what you're doing, I would say stop now. But if you are getting the most out of it you possibly can, then you keep going. It's an asset, not an expense. So you can't think of the $10,000 you've spent as debt and as an expense. You have to think of it as an investment, and it's a carry trade. You're investing in an asset that can only appreciate in value, but your loan will only depreciate in value as you pay it down, right? So no, do not quit. We can leave that one there. You often say it's smart to set max loss at twice the expected gain. Well, no, I don't say it's smart to do that. I say if you are in the business if you decide that your strategy is income, you're going to run an income portfolio with theta, then you have to have rules. The typical rules that I would say, I won't call professionals, but more expert income traders follow, is that when they sell a put, they will, if for let's say 50 cents, use the example of 50, you'd set a stop loss at 150. No, you sell for 50, you set a stop loss at $1, period. And that's it. And if you're selling 10 delta or 15 delta or 20 delta puts, you're playing the probability distribution that if you're selling 20 delta puts, 20% of the time you're going to lose, 80% of the time you're going to win. The experts who do this will typically follow that strategy of taking a loss at twice the amount. You may decide that that's not for you. That over time you've learned to do it with a better rule. You may find that that's okay for you. But I'm just giving you what you would expect the conversation will look like when you bumped into another person who said, "Yeah, I'm a theta seller too, or a theta trader. I take losses at this much." You say, "So do I." That would be quite common. Are there any indicators that 3-month 10-year curve may begin to uninvert? Usually it begins to uninvert when the Fed starts cutting rates. That's your indicator. Also, is the uninversion typically caused by investors, the Fed, or a combination of both? Well, the Fed's got to get the ball rolling. Investors take it from there. Okay. Some workers in the back are here, and I can hear the music playing, so hopefully my microphone won't pick it up. Hi, I'm a grateful student of yours. Cheers to your new home. Can you speak more about your deflationary scenarios? Some context. Previous market outlook, you mentioned a decrease in unit cost leads to deflation. I didn't quite say that. I said a decrease in unit labor costs is deflationary. Whether it is deflationary at the aggregate level of the economy is a different story. It doesn't mean that we're going to get deflation because unit labor costs are negative, but it is deflationary. So whether that continues and we actually see deflation at the aggregate level, different question. It certainly puts downward pressure on inflation. So we should, at the very least, see disinflation, which for today's PPI, we absolutely saw it. Now, the recent market outlook, you added a quick insight for the case of deflation being more plausible in the long run. Yeah, because technology won't stop. Technology will not stop, and neither will the global marketplace. Okay, so some supply chains are nearshoring. That's fine. But that doesn't mean that just because they're nearshoring, there's going to be a lack of technological improvement. If anything, if you're nearshoring and it results in an increase in labor costs, you will substitute capital for labor. Technology will not stop, and technology is deflationary. We are going into a more technology-driven world, not a less technology-driven world. That is deflationary. In your UBS Global Market Real Estate video, you spoke about foreseeing capital flying out of the economy. Well, if governments don't restrain themselves, the capital market will do it for them, in the sense that capital will simply leave. So one of the things that we learn at level 3 CFA when you're designing a portfolio is not just asset allocation, right, but asset location. That means where you place your assets. And you have typically a tax-deferred account. You also have tax-free accounts, and then you have taxable accounts, and you usually concentrate your highest taxable assets in the tax-deferred and the tax-free. One thing that we really don't consider when we talk about location is when we look at an economic balance sheet for an individual, not just a financial balance sheet, but an economic balance sheet under assets, is the present value of human capital. Well, that is an asset. Well, where are you going to locate that asset? That is the individual. So if you can locate that asset, if it's possible to locate that asset in a preferable tax regime, which is what Costa Rica is here. I have a territorial tax system, which means my income, being that it's not generated within the territory of Costa Rica, is not subject to Costa Rican income tax, nor am I subject to Canadian income tax or American income tax. So I go from 53.5% to zero. That is asset location. All right. So if you don't have governments that aren't going to control their spending and simply just going to say, look, we can always just raise taxes to get spending, or worse is that we can promote inflation to get, without raising tax rates, but to get higher tax revenues, we can inflate the debt away. Capital will leave, and human capital will decide that if I can change my location, I will, which is what I did. I simply changed the location of a very valuable asset, which is my earnings potential. Let's see, capital flying out of the country, the government running deficits right up the wazoo. I don't see that ending anytime soon, do you? I don't see that ending anytime soon. Canadian government just announced that, hey, everybody gets free dental care. We'll start with these groups of people, but now you're going to get free dental care. And who's going to pay for that? Only 50% of Canadians pay tax, and they're not going to raise taxes on the lower income groups. So who's going to pay for that? The successful people in Canada will pay for everybody's dental work. The successful people in Canada are more likely to be able to change their asset location. So what are you going to get? Capital flight. You will. To more tax, eventually capital control. Well, when you have a country and capital is leaving, this is the problem with deciding to socialize all the costs, right? If you have a government that decides that everybody should get free healthcare, everybody should get free university education, everybody should get free dental care. In fact, everybody should get a minimum income without having to work for it. Once you start socializing all of those things, it only works until you run out of other people's money. Well, whose money are you going to use? You got to use successful people, right? They have the ability to leave. At that point, the idea of putting capital controls in, either you give up on more socialist agendas, or you have to tax capital on the way out of the country, that you're free to leave, but you can only take half your money with you. There's an exit tax of 50%, or whatever your income tax is, that is your exit tax. So if I had to pay 53% of my overall wealth just to leave the country, it wouldn't have made sense to leave. See, that's how they would trap you in the country, by putting an exit tax on. It wouldn't be surprising if a country had a drain of capital, that a more left-leaning government would say, you can leave, but you're going to pay your share of the national debt before you go, and it's half your income. That it wouldn't be surprising to me. I'm not predicting that it'll happen. Just if it did, yeah, it wouldn't be surprising. If you want to hand out checks to people, just to hand out checks to people, why is that such a far cry to say, if you're going to leave the country with your money, you can only take half of it with you? Why is that such a far cry, right? I seem to think the last one leads to inflation, but could be totally wrong. Well, if it did lead to inflation, it would be country specific, like Argentina or Venezuela. It would be country specific. It wouldn't be global. Given the run-up in the Magnificent Seven this year, what are your thoughts about going long RSP this year instead of SPY? The thesis being that given the lofty valuations of the Magnificent Seven, the average stock could outperform the big boys. Yeah, I think you have something there. Yeah. In other words, the S&P less the 7. Although I don't, it's just that the 7 are so big, they're held by everyone. Like every fund holds them. So for the 7 to not continue to perform as money goes into passive funds, those 7 get bought in that proportion. So from a structural perspective, I don't see a short position there. One of them would have to stumble, or two of them would have to stumble. But just to say, oh, we're tired of it, we think everything else will outperform, you'd have to have funds all over the place that also decide to underweight. But they couldn't just wholesale sell, because if they're tracking the benchmark holds it. Apple is in how many different indexes? and how many different funds are tracking how many different indexes that have no choice but to hold it. You have to hold it. So until there's a stumble in that space, until IT is out of favor, I just wouldn't touch it. I don't know that I would make too much of a big bet on that. For the long term, what do you think of investment? 50% in SPY, 50% in SPY 2x leverage? No. None of that leverage stuff. Stay away from it. If you want to leverage, use leverage to lever up SPY. Although your borrowing costs are very expensive right now, but don't use an ETF that has embedded leverage. Those are meant for daily returns. Just stay away from those. Stay away. No, I don't agree with that. If you want leverage on SPY, if you want to get more leverage without actually having to pay for the leverage, let me show you how to do it. You can create, for instance, if you buy SPY and it goes up, you go up dollar for dollar with SPY. Is there some way that we can go up faster than SPY? And there is. Is what you can do is you could buy a rather than use a synthetic, that is you're short a put and you're long a call. What you want to do is move your put to in the money, short a put that's in the money and use the call. You'll get a delta that is greater than 1, and you can set your own delta for what you want. You move your call down. So let's say S&P is at 465. What you can do is sell a $500 put and buy a $400 call. You'll have a delta here that's greater than 0.5 and a delta here that's greater than 0.5. Maybe this is a 0.8 delta, maybe this is a 0.8. You get 1.6 delta. So now you have leverage. So you'll get a return that looks like this. Like it'll have a sharper slope in the middle from 465 to 500. You'll have that leverage, and then after 500, you are back to, it'll approach 100 delta. Create your own leverage. Don't rely on these funds that have embedded leverage. Okay, you can create your own leverage. Let's see, it would be nice to have a video explaining all the concepts you cover on these market outlooks. Somebody replied to you with a link to that video, and I've already done a video, yes. Currently holding a small company, market cap of less than 80 million. This will be my last question before I have to break for the FOMC press conference. I will come back and answer the rest, but this will be the last one before I break. Small cap company, market cap less than 80 million. Net income trailing 12 months is 12. That's not bad. Free cash flow, 25% free cash flow. Debt to equity is around 50. Oof. It's a nice little company there. Do you have any thoughts on when smaller companies trading at good valuation levels begin to see larger money managers take notice of the opportunity? 80 million is too small. 80 million is too small for a fund manager to take a position. It doesn't have the size for the size they need. It doesn't have the size. What could they do? Take $1 million position? Even $1 million, you're 1/80th of the outstanding float. So if they want to come in with 8 million, they're buying 10% of the shares, which may trigger some disclosure rules above 5%, right? It's too small. It doesn't have the size that the large funds are going to need. Now, it has market cap of 80 million, but are all those shares representing the 80 million available for trade? It may not. There may only be half of the market cap available for trade because the rest are held by insiders or long-term buy and hold. It doesn't have the capacity for fund managers. So that's just not going to happen. Okay, that's not going to happen. Wondering if I should buy more now or wait to see if a market downturn pushes their stock even lower. Well, what's your holding period? If your holding period is 3 months, then you got to try to time your entries and exits. If your holding period is the next 5 years, who cares? Who cares? Let's do another one. If banks lose fees for FX, currency market, or some other business lines to CBDC or other apps, then do you see global consolidation? Smaller ones getting eaten up. I don't know if the smaller ones generate enough fees in transfers that they would feel the need to consolidate with a larger one, but a larger company might, it might see opportunities, but I don't know that in itself is enough to motivate M&A or consolidation. because they'll adapt. They'll come up with something else, and they will adapt. And there'll be fees for something along the way, or different types of fees for different things. But I don't know enough about what CBDC is going to gobble up in terms of other services to really have an opinion there. Okay, let's watch that press conference. Okay, press conference over, but with the winds here, I suffered a brief little power outage, which means I had to reset up the comment section, and the questions just fall slightly out of order, so we may come across a few that we've seen before. I agree that copper is going to be the thing to invest in. What's your favorite picks for copper mining companies? Well, there is PIC, right? That is an ETF that tracks copper mining companies. When you're looking at the copper mining companies, you're looking at two things. Number one, the net unit cost for copper. Because when you mine copper, you get gold, you get silver, and you'll get molybdenum. And all of these can be sold as an offset against your costs. Sometimes they can be sold to the point that you're already generating revenue before you've even sold a single pound of copper, which means your net unit costs are actually less than zero. The mine is actually making money by mining the copper without even selling it yet. So you look at the net unit costs. That'll tell you how profitable each pound of silver is. And then two, you got to look at volume. There's no point in having net unit costs of zero if you're only selling 10 pounds of copper a month, right? You want a combination of volume and low unit costs. The higher the volume you're going to get, you're not necessarily going to get your costs all the way to zero. I like Freeport because they're concentrating expansion in Indonesia. Indonesia has pretty much zero cost of copper, so that makes it a nice destination. Video explaining all the concepts, that's already been answered. We've already seen this one. Do you know where I can find data for implied future policy rates in Canada? Right at the Bank of Canada website. I believe they have it there. However, I will tell you, I can't figure it out. The grid that they use, I looked at it and I tried to make sense of it, and I said, oh, hey, no. Oh, no, this is, no, that's not it. And I couldn't make sense of it, and I thought, if you guys can't come up with something simpler, then you don't even know what you're tracking, so I'm not going to waste my time. But I couldn't figure it out. If you can figure it out, let me know. What would it take for ABR to cut their dividend? Liquidity crisis. Something that threatens their ability for short-term funding. Basically the repo market. Something that threatens their ability there. That would be the thing that would allow them or force them to cut their dividend, because they'd have to conserve cash from all places if they have a liquidity problem. They don't have a liquidity problem. So a short-term drop in earnings, a challenging marketplace, they're not going to cut their dividend. Only if they have a liquidity problem will they cut it. For selling puts for GM, don't have a lot of capital in your margin account, would you be doing bull put spreads? Yeah, you can do that. Sell the 33s, buy the 31s or the 32s. I think you'd want to buy something with low value, so sell the 33s, buy the 30. You got a $3 spread. That's all you really need, is $300 for every spread that you sell. So if you only have $900, you could do 3 of those spreads, right? Curious to get your thoughts on Oxy underperformance. Well, when we say underperformance of what? You have to look at, because it's commodity driven, you have to look at the commodity price and you have to look at its peers. Is it underperforming its peers? Maybe underperforming the SPY, but it is very oil price dependent. Is it underperforming its peers? For Oxy, you have to get comfortable with a certain cash flow yield. If you like a 15% cash flow yield, and whenever the price represents a 15% cash flow yield, you just look at cash flow per share and figure out what 15% would be, and that would be your entry price. Is now a good time to DCA. Again, don't compare it to SPY. Compare it to its peers or compare it to its free cash flow yield and be comfortable at a particular cash flow yield. ITB versus XHB for housing market exposure over the next decade. One is construction, one is a home builder index, one is construction index. The construction index will have more in there. So you'll get more companies in the whole chain not just the home builder ecosystem, but in the whole chain. ITB is more broad than XHB. I don't know that I have any particular favor for either one. They tend to, I think their correlations are high 90s. Why did you say when institutional money flow increase in money markets, the reverse repo should decrease? Well, no, I'm not saying that there's a one-to-one relationship that way, that there's an inverse relationship. It's just if I see equities going up and duration performing well, and I see money market accounts increase, it is consistent with the reverse repo dropping. Then you would say, okay, well, it's money that really belongs in the money market, because that's what a reverse repo is. It's the shortest of all money markets, guaranteed by the Fed, or not guaranteed, but funded by the Fed. The return is funded by the Fed. That if I see money market funds increase and the reverse repo decrease, I say, well, that was money that belonged to the money market anyways. But when you see the reverse repo increase and money market funds increase, while markets are increasing, while bond markets are increasing, it's like, well, usually excess money hides in the money market for safety. And when it is risk on, money flows out of money markets either into the long end of the bond curve, into duration, or into beta. But when everything is going up, it's like, well, it's not consistent. That's all. It's just not consistent. But I gave a theory this week saying that maybe it's just, a lot of money is thinking, well, I'm going to go into my registered accounts January 2nd. And I don't want to take any risks, so let me put it in money market funds right now. And then in January, I'll take it out, and then I'll put it into risky assets. So there could be a lot of money just waiting for contribution room to open up January 2nd. It could be that. How was your life in Costa Rica so far? Food, entertainment. Food takes a bit of getting used to. You're not going to get the same things that you had, and even when you do get the same things, the taste is slightly different. So I don't make ground coffee. I have instant coffee because I just don't have it that much, and to make one cup with the whole production just seems like a lot. It's just easier to use instant coffee. I mean, it's just really quick. I use the same thing down here in Nescafe, but the coffee it's a different taste. I can taste it. It's different. Same with the Coffee Mate. I don't like milk. I don't mind the Coffee Mate. It's a different texture. It's a different consistency. It does have a different taste. It's not as strong a taste. It's not as good a taste as the Coffee Mate in Canada. Maple syrup's a little bit different down here. It's not as bold. Not as it loses something here. It's more sugary here than wild, more mapley wild that you would get in Canada. It just seems to be a jar of sugar down here, even though I know maple syrup is sugar. But it has a different taste. So some things, the taste is a little bit different. My life down here so far has been frustrating because, I don't really speak the language. I'm learning it slowly, but, not to the point that I can have conversations. You got to learn the masculine, the feminine, the singular, the plural, the conjugation of the verbs, and then you start building from there. And every day, with a property this size, there's always something that needs repairing. And big properties always need constant maintenance. But when the previous owner disregarded maintenance for a few years, you have a whole bunch of micro issues that you only discover when you live in a place, not when you tour a place, because you don't think of looking at the little things. You have to live in a house for a week or two to discover all the little things that you never would have noticed before. So when you plug something in and the outlet doesn't work and you test the outlet and the outlet's dead, it's like, well, I wouldn't have known that. Well, now I have to have that fixed. When you turn on the outside lighting and one light doesn't turn on because it filled with water, it's like, well, you need an electrician for that. You didn't see that. All the little tiny things. So it has been frustrating because you cannot have people come out to the house and quote you on something. Just let me give you an example. I have a big, long pool, 76,000 liters, which is bigger than my pool in Canada, 76,000 liters. It's a saltwater pool. But it was really dirty, so I emptied it, cleaned off, and everything is well water here, so the mineral buildup, the calcium and the lime was incredible. Scrubbing it down, I'm going to fill it up. The pool company comes by and says, okay, the salt is $3,000 USD. I need 220 kilograms of salt. So 20 kilogram bags of salt in Costa Rica are the equivalent of about $12 US. So basically, I can do this whole pool for less than 250 bucks. I get quoted 3,000 because they come out to a big house on a hill with stables down here and a running track in here and big 6 acres. And it's 14,500 square feet. So they look at the house, the price goes up. They look at me, the price goes up because I'm not a local. They hear me speak, no Spanish, the price goes up. So this is what you have to put up with. That's how ridiculous it is. 3,000 versus 250 because they think, well, he doesn't know the difference. Yes, I do. I'm not stupid, okay? I may not speak your language, but I'm not stupid. But you have to put up with that kind of stuff. Went to the bank the other day, and every bank has a lineup outside. Every bank has a lineup to go in. I wanted to use the ATM. So I'm next in line. The person goes to use the ATM. They leave. The security guard here tells this person to go in. Okay, so fine, goes in, uses the ATM, and the line moves. That person leaves. Security guard tells the next person behind me to go in. By the time they told the third person behind me, I walked right up to him with my arms spread. I said, "Oh, enough of this." And he finally let me in. But you got to put up with that. That's a little frustrating. So, yeah, I'm not, the majority. I'm a minority. And you do see, that you are treated a little bit differently. And all you got to do is stand up for yourself, and you get in their face and you let them know that you won't let that happen, and it's okay. I told the pool guy to get out. I just pointed, I said, get out. And somebody else translated it for me. And he left. It's frustrating. I'm going to do a whole video on this about things that you need to be aware of, things you don't. I bought a car. I was warned, do not go buy your own car. Not you. Hire a negotiator who's a local to go in and negotiate the car for you. Pay them the $200 or $300 they'll ask for, but get them to go in because you're going to pay a lot more than you think, and you're going to get a lot less than you realize, because there's all sorts of fees in behind buying the car. All these different fees. Well, you can negotiate all that in the price of the car. Well, they'll get you if you don't know. So it's dukes up. You got to protect yourself every day. But more about that later. But you know what? It's just a matter of getting used to it. Getting used to it, being prepared, and letting them know that, hey, look, I've already got 2 other prices. As simple as that. Any thoughts on the local property market? It is a buyer's market. I will say that. It is a buyer's market. Less of a buyer's market than it was 6 months ago. I'm seeing that, as I started negotiating with some houses, you move from one to the next. I found that owners, as time went on and I was, negotiating on different houses, were less flexible over time. So it's firming up, but it was, 4 or 5 months ago when I started this process, very much a buyer's market. Recent credit downgrade of China seems to have affected copper companies. I saw your recent post on LinkedIn that shows a strong demand for copper in the next years. Why is there a sentiment issue? Well, that's randomness. That's the day-to-day randomness of the market, period. There's nothing you can do about that. That's all it does is set up a buying opportunity. The market will be way more volatile than the fundamentals. Always, always. So if you realize that, it sets up opportunities to sell puts on a big down day like that. Sell 365 puts, sell 350 puts on the next contract out, on the next futures contract. Sell puts on COPX, sell puts on FCX. Use the stupidity of the market. That kind of volatility, use it to your advantage. If you're going to sit down at a poker table with a bunch of people that don't know poker, don't lecture them on how to play poker. Use it to your advantage. Use their stupidity to your advantage and take them for everything they got. The market is the same way. Don't browbeat the market and tell them they need to do things right. Just say, you're doing things wrong, and I'm going to say nothing about it because you're just dealing into my hand. This is beautiful. So yeah, just, if a move to you seems contrary to the fundamentals, and you'll get that a lot, is just say, I'm not going to teach these people how to play poker. I'm just going to take their money. How does one invest in agency MBS? Every broker, at least I shouldn't say every broker, most brokers, especially if your broker's through a bank or a significant broker like Interactive, with a global footprint, most will have a dealer desk that you can call and buy MBS. They can buy it for you. You're referring to REITs such as ABR? Nope. ABR is a mortgage REIT, but not in the way, they don't buy MBS and lever up MBS. They don't do that. They're a different type of mortgage REIT, different than what agency would do. What would be a bullish case for MREITs if the economy goes into a recession on their cash flows and stock performance? In a recession, rates drop, bond prices increase. So that's bullish for anyone. Any financial statement full of financial assets is the present value will go up. The supply of new mortgages coming onto the market will drop, which means when they need to reinvest, it might be hard to get a good price because the supply would decrease. So that would set up overpaying for new MBS. But overall, their balance sheet would have a net positive effect. Their funding costs would drop very quickly because they use repos. Their funding costs would drop quickly, but all of the assets they bought over the last 2 years, or the last year and a half, would have higher yields. So it would be a net benefit. As interest rates drop, in a recession, mortgage activity pulls back, but that's only for a couple of quarters. With rates low, that does encourage more mortgage activity and then more coming supply. Sectors you think might outperform in the next market cycle, they're always the same sectors. IT will outperform, communications will outperform, and consumer discretionary. Always the same guilty culprits. Besides your account with Interactive Brokers and any subscriptions you have to news resources like Wall Street Journal, Barron's, do you have any other subscriptions you would recommend? Not really. I don't have many subscriptions at all because all economic data is free. Fred is a great resource. And all financial data is free, and usually most companies will provide you with investor presentations which aggregate a whole bunch of past data for you. If you're an institutional investor, you're going to need a source to get you 5 years or 10 years of quarterly data all cleaned up. If you're a retail investor, you don't need that. It's of no value to you because you're not going to have the resources to really use that data, and everything you do with that data is going to be a forecast of just best guesses. So I find that is just sort of useless for the retail side. Fall in oil prices, what's causing it? Well, more supply than demand. It's with commodities, it's a really simple equation. If prices are going up, it's more demand, or at least more perceived demand than perceived supply. If prices are going down, it's more perceived supply than perceived demand. Rumors on Oxy doing an acquisition already happened. Would it result in a decrease in their share price? Maybe, maybe not. There is the textbook and there's the real world. What the textbook doesn't account for and what it cannot account for is investor sentiment. So a company announces an acquisition. Is sentiment going to be, oh, that's going to be great for the company and the price goes up? Or is it going to be, well, the textbook says the price will go down, so it'll go down? I don't know. Depends. Most of the time, the acquirer's price goes down because the belief is that they're overpaying. Sometimes they don't overpay, though. So, I don't know. Beats me. It really, all you can do is guess. And the only way you really know is to wait till the market opens and watch the price. I mean, that's the only way you're going to know, right? Also, how was the last Friday copper price Goes from 393 and then immediately down Monday 379. Randomness and sentiment. It's just randomness. If you're looking at a reason for why did this happen today, 80% of the reason will be randomness. Just randomness. It just so happened things happened that day and it was purely random. That's all. Muddy Waters Research short position on Blackstone Mortgage Trust. That is, I think, because of their office and retail exposure in that portfolio. Thesis seems to be more about the CMBS sector rather than the intrinsic characteristics. Yeah, pretty much. Canadian tax question. If I bought shares of a Canadian company for 100, company's making a public share buyback for 110. Non-residents, the company will pay out the value of the paid up capital, the common shares 10, and the rest is a dividend 100. Well, how do they know what you paid though? Like you said, you paid 100. I'm sure this is a manufactured example because the numbers are just too round. Nobody ever pays 100. It's like 99 and whatever, but 100, you're just using examples. The rest is a dividend 100. How do they know what you paid? Like, how do they know what you paid? What if you paid 98? Would it be 98? What if you paid 102? Would it be 102? So if it's an example, I'm confused. Is the dividend the 100 based on what you paid, or it just so happened to be 100 and you just so happened to pay 100? If it is, then when you do examples like this, try to make different numbers to make the distinction. They're taking 25% withholding. Well, if the company is making a public offer to buy back a significant amount of its shares as opposed to trying to buy it back in the open market, then whatever it gives you, there's going to be two components of it. One is going to be return of capital. The other will be the capital gain. The return of capital is going to be based on the book value of the shares that they buy back, not what you paid for it. Right? When you get your dividend, unless it's a trust, unless it's like a mutual fund trust or something like that, but it's, I don't have enough information here. I'd push back on a whole bunch of stuff. How are they making this tender offer? If they're issuing these if they're calling them certain things, it's got to be based on their book value. That much would be return of capital. The rest would be as a dividend. But it would be based on what you paid. Like if you paid 112 and then the price dropped to 100 and then they made the offer at 110, you would have a loss. I can't speak for tax rules in any other country of how that's going to be treated, but if the 100 is the book value, then the 100 would be called return of capital. There is no tax on return of capital because it is just a return of capital. Large buybacks, look at CI just announced 10 billion. The size of the buyback in dollar values is not important. What if it's an $800 billion company buying back 10 billion? That's nothing. GM is a $39 billion company buying back 10. They're buying back 25% of their market cap. So it's not 10 billion, it's 25% of their market cap. So is this company's 10 billion represent 25% of its market cap or more? Then that's a big one. But they could be a $800 billion company doing a $10 billion, like Apple doing a $10 billion buyback is nothing. It's nothing. Because they're what, $2.5–3 trillion company, over 2 trillion, 3 trillion now. Them buying back 10 billion is nothing. Them buying back 50 billion, they could buy back 100 billion, and it would still be less of a buyback than GM buying back 10 billion based on their market cap. Wondering if you had any thoughts surrounding recent small cap performance. Nope, I'm not even aware of what recent small cap performance is. Opinion of the Magic Formula of Investments, little book that beats the market. What was that now? Everything in that was based on EBIT because it had to be a number that did not include the way you financed your assets nor the way you are taxed. So it is EBIT as a yield, EBIT over, and I forget what the denominator was as a yield, and then EBIT as some kind of multiple of some cash flow or multiple of price. I think something with enterprise value. I forget. I think it was EBIT over enterprise value and something. I forget what it was, but I know dealt with EBIT, which is the right way to look at a company. If you're looking at the ability of a company to earn, you should look at it based on its earnings from operations, regardless of how it's taxed or how its assets were financed. Oxy's recent purchase, I see little of comments related to preferred shares. I didn't see preferred shares. I saw 1.7 billion in shares, but I didn't see the word preferred there. So it's 12 billion. They're assuming 1.2 billion in debt. They're issuing another 9.1 billion in debt, so it's 10.3 billion in debt, and they're going to issue 1.7 billion in equity. Highly leveraged buyout on that one. No cash, because of course they're going to raise the cash by selling $1.7 billion of stock, and if the price is going down, the dilution becomes greater, which pushes the share price down, which means the dilution is greater, which pushes the share price down, it follows that. What conditions would participate as 30% rally in long bonds? Depends on the duration. So if you want 30%, it is 30% equals it's negative duration. Let's say the duration is 20 times the change in rates. Solve for delta R to get 30%. That would be 150 basis points. If you have a bond with a duration of 20, 150 basis point drop would be a 30% increase in the price. In regards to the jobs report, what's the difference between household and establishment jobs added? Well, one is a survey of households, one's a survey of establishments. I think the household one has more error in it, has more sampling error. It was replied. I looked at the reply directing you to the methodology section, which is probably what I would say, is just check the methodology section. You'll see the difference between the two. Curious, which suburb did you live in? Fonthill. 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 Since you already moved, hope you don't mind sharing. I know you mentioned you were in Brampton before, up to 2016. Moved in December of 2016. Probably lived elsewhere after Brampton. Yep. Right there. Stouffville. No, not Stouffville, because it has a main street. Seems like an odd reason to pick a town. I'm looking for a town that has a main street. No main street, I'm not going. No, I don't get that. A videographer told me about a mic that is sensitive only, sounds very close to the mic. Okay. How widening spread makes agency MBS a screaming buy? Well, because it has it's agency, which means it has an implicit, well, not explicit, but implicit government guarantee. So it's basically a government guaranteed security, and if the spread keeps widening, I'm getting paid more for credit risk that doesn't exist. So yeah, I'll take it, right? Your next two questions I can see are about the Viceroy report. That was not a real report, right? That's just mudslinging. That's just a couple of, I guess, I don't know what you'd refer to these people as, losers seems to be too harsh of a word, or not really the right word. It was not meant to be a serious report. It was meant to just throw mud and scare people. They get paid by hedge funds to write shit reports like this. These are little punks. There's a good word for them. They're little punks swimming in waters they don't understand. But their job is not to understand it. The job is to make shit up. And that's all they are. Little punks with little brains, with little ability to do anything else other than lie. And that's it. They probably couldn't do serious work if they tried. I don't think that they have the intellectual horsepower to get that done. So I would ignore them altogether. Just ignore them like their parents do. On your market outlook, January 16, 2023. Well, we're going way back, aren't we? You made the case that soft landing doesn't seem possible. You back up your thesis partly by explaining how growth requires an expansion in employment. The unemployment rate is already very low, and that in order for companies to add employees, they would need to have to raise wages, which will reduce margins and raise prices, which pretty much we've seen through 2023. The only difference is 2023 came with growth. Now, growth pretty much came in the third quarter, but productivity was huge in the third quarter, 5.2%. So if you think about productivity at 5.2 and GDP was upgraded to 5.2, all of GDP came from improvements in productivity, not increases in volume. And this seems to match companies when you look at their third quarter earnings, look at some of the goods companies of how they made their income year over year. Quantity, very little change in quantity, big changes in pricing. That it was pricing and the mix that made the revenue, but not really an increase in volumes. So quantity fairly flat, but productivity way up. Why do you think we've seen GDP increase while unemployment is also increasing? Due to productivity gains? Pretty much. Improvements in technology such as AI. Well, not AI, but productivity gains. You can get a productivity gain by laying one person off. So let's say I have 10 people making 100 units and I say, look, get rid of one who's just not doing anything, and I don't add any technology whatsoever, and I go down to 9 people. I've just increased productivity because each one was making 10 units before. Now each one is making 11.1 units. I just increased productivity by 11.1%, right? Going from 10 to 11.1 is an increase of 11.1%, 1.11 over 10. I've just increased productivity just by getting rid of one person. So just by streamlining my operations, just by cutting a few costs here, by getting rid of an employee, by doing all of these things, I can increase my productivity. So you can increase productivity without increases in technology, but to actually have that translate into GDP, you would need some kind of technological advance where, you know, technology did the heavy lifting and not the individual. But it's too soon for AI. Now, if you think, well, you know, lots of companies are using AI. They've just changed the name to AI. It's like me changing my name to Stan, you know, and then saying that, you know, like, look what Stan's doing. Stan's hitting the ground running. You know, Stan already knows so much. No, Stan doesn't know a lot. Mark knew a lot. I just changed my name to Stan. They just changed the name to AI. Previously, it was called Predictive Analytics. And that's been around for a long time. Have you ever done a regression? That's predictive analytics. You use the regression to predict the next outcome if you're using it over time. What are sales going to be next quarter? Well, my regression says it'll be this much. That's predictive analytics. But now, if you want a boost to your share price, you have to say we're using AI, predictive AI. Change analytics, PA to PAI, predictive AI. Same thing you were using 10 years ago. Oh, you got a regression equation? So do I. But now, you don't call it statistics, you call it AI. It's AI. We're using AI to improve our forecasting. Oh, really? The new thing is generative AI, which does not rely on past data to extrapolate something into the future. It relies on a body of knowledge to create something out of that. It generates something new that is not part of its data set, thereby creating new data for its data set if it was right. That's generative AI, and that is not ready for prime time at this point. Do you still hold the same thesis going into 2024? You know, the thing is, I don't know. Micro, I have a lot of good micro ideas, but if you ask me where beta is going, I got no clue. I can flip a coin and be equally comfortable with the both outcomes. I just don't know. If we do have 1.4% growth next year, like the SEP, the Fed's SEP is suggesting, then the only way to get better growth in earnings is to cut costs. But if you cut costs, you cut somebody else's revenue, somebody else's income. If you do that, you start chipping away at aggregate demand. And if more and more companies start doing that, then you could, you know, float right down past that soft landing into a hard landing, because that becomes self-fulfilling. More companies see the unemployment rate go up, then they lay off in anticipation that their demand will be hit, and when they lay off people, they hit the demand of other companies. So, thoughts on the 150 million ABR buyback? Well, listen, this company gets no respect. Since after 2008, 2009, around 2010, 2011, they started performing. They reinstated their dividend. And for 13 years, they've been performing and raising their dividend, and they get no respect. For some reason, this stock has to yield 10 to 14%. I don't know why. Even in a good market, it was yielding, 9%? I don't know why. Really, I think this stock, with the franchise and the management experience that they have and the track record they have, this should be, in this market, probably yielding 8%, in a good market yielding 6%. So it's paying, $1.72 a share, and it's $14, 12% yield. It should be, I think, even at a 10% yield, it would be a $17 stock. So it really should be a $20 stock, and that's assuming a difficult market. And it's at 14. So yeah, buy back. It makes sense to buy back your own stock. If the market's not going to respect you, then you don't need the market. Buy it back. Let's see. I don't fully understand why you should place puts when the company announces a buyback. Well, it's simple. You have fewer shares that will be outstanding. So if you expect the same level of sales, the same revenues, the same earnings going forward as before the buyback, like buying back a share of stock should not affect your revenues, should not affect your net income, which means if you have fewer shares, every share has higher net income. So even keeping the same PE multiple, each share should be worth more, period. You considered adding a face cam to your market outlooks. That would take me further away from turning them into podcasts. You're way at one end of the spectrum. Hey, put more visual into your video. Somebody earlier is way at the other end of the spectrum. Make your videos voice only so they can be podcasts. I'm going to stay pretty much right where I am. S&P will test 3,500 in 2024. Yep, said it. Call me crazy. Well, if you have the scenario I said earlier where you have low growth and you have companies that cut costs to make their numbers, every dollar they cut was somebody else's revenue. And if enough companies do that, then it affects everyone's revenue, so they do it even more, which affects everyone's revenue, so they do it even more. And then some companies will do it in anticipation that the revenues will be hit because they see other companies doing it. If that takes hold, if that sentiment takes hold, then yeah, you could see 3,500. Well, I mean, you could see downside. Whether we get to 35, I don't know. I don't think we get there all at once, but if you have a slow bleed in earnings over a period of time. Same issue on Vimeo again. No. You ever get lonely? No, actually, I don't get lonely. I think if I were a younger man, I'd get lonely. I think youth craves social environments. A 30-year-old, I don't think is ready to close the doors on a social life. I've done my tour of the social life, and I'm good. So no, I don't really get lonely. Maybe that is a function of the type of friends I've had in the past. That I didn't find, that the payoff was worth the investment and the effort in the end. Maybe it was just I get just a bad choice in people that I associated with. Could be that I think, well, what do I miss that for? That if I had probably better friends and good people around me all the time, then yeah, I probably would get lonely because I'd say, like I'm missing that big part. But no, I'm not. I don't get lonely, but I do get bored. You can only do so much of this stuff. Like you can only look at the market and read 10Ks and listen to different academic videos for a while, even listening to your own and doing your own research before. Sometimes you just say, okay, you know what? I can't take it anymore. Give me a day off. So I do get bored, but I don't get lonely. Anyways, that's it.